So recently there was a tax court case that dealt with a short-term rental and the taxpayer lost. And here's a few reasons why they may have lost. If you have a short-term rental, you should pay attention to this because tax court cases really gives us an inside look into how the IRS and the tax court actually views certain laws, and it can really help us navigate certain strategies. So pay attention to this message because it could really help someone out sometime. Now, even though the taxpayer lost, whenever I start to give you these numbers, the taxpayer only lost about $5,000 in tax savings. But the thing is that some other taxpayers are dealing with much larger numbers. They're dealing with $10,000, $20,000, $30,000, $40,000, $50,000, maybe even $100,000 of tax savings with using short-term rental strategies. So even though it wasn't as big of a burden for this particular taxpayer, it can always be much worse. So in this particular case, the taxpayer actually argued that they had a short-term rental. However, their rental actually didn't qualify as a short-term rental. Remember, to qualify as an STR, you have to have an average tenant stay of 7 days or less. That's one of the main criteria in qualifying. They were more of a mid-term rental. Their average stay for a tenant, however, was closer to around 30 days as they were doing more so mid-term rentals. They were still using Airbnb, but the average stay of each tenant was much higher than 7 days. And so this is one of the first mistakes they made. They didn't even realize that they did not have a short-term rental. They were looking at it as if it was a short-term rental, heard about all the different benefits, but they actually had what the IRS looks at as a long-term rental. Even though it was a mid-term rental, even though they had it on Airbnb, it's still classified as a long-term rental. And whenever you have long-term rentals, you actually have a few more hurdles you have to jump over in order to treat your activity as non-passive. This is known as real estate professional status. And if you have a full-time W-2 job, you actually have to spend more time in your real estate than you do at your W-2 job. And by default, if you work a full-time job, the IRS may assume that you work about 2,000 hours. So you're looking at it working in your real estate more than 2,000 hours in a year. And more times than not, this is just not going to be the case. Now, every now and then you do have situations where maybe someone works part-time W-2, and so now they actually have a much better opportunity. You have to be a workaholic. And even if you do meet this criteria, the odds are going to be stacked against you because you may not even seem credible whenever you present your documentation at first. You may need to even bring in witnesses to testify for you on your behalf to show that yes, you actually are a workaholic. There was one case where a taxpayer claimed real estate professional status and the IRS didn't believe them because they also had a full-time job. However, when they were in court, they brought in witnesses and they actually used those witness testimonies to actually prove that he may have qualified for real estate professional status because their employees were actually complaining about how much of a micromanager he was and how involved in the day-to-day work he was in the business and how annoying it actually was. Funny how that actually worked out in his benefit. Now, circling back to our current court case, this taxpayer had a full-time job as well and unfortunately was not able to prove that they spent more time working in their real estate than they did at their W-2 job. So remember, if you are looking to use real estate to offset your income, there's a few things that you have to look at, and a lot of it revolves around passive activity loss limitations. Number one, by default, your rental is going to be a passive activity. So you may want to look at real estate professional status in order to treat it as non-passive. There are a few exceptions to the rule, and one of the most mainstream options out there is going to be your short-term rental, where the average tenant stays for 7 days or less. Now again, this is just very high level and there's a lot of nuances that go into this, such as you don't want to stay at your property for more than 14 days in a year or more than 10% of the total days rented out in a year. Otherwise, the property may be treated as a personal property and you won't be able to use any of the losses to offset your income at that point. So if you are a real estate investor and you want to work with someone who will educate you on how the tax code actually works and how you can bulletproof your strategy to protect yourself in an audit, feel free to reach out. We're still taking on clients for the year and we'd love to work with you.